Alright, let's start with the basics. There are two primary ways to make money: working for a salary and using your money to make more money through investments. When you work for a salary, it's like trading your time for money. It's reliable, but there's a limit to how much you can earn. Now, on the flip side, investing is where your money becomes your financial employee. It works for you even when you're not working. But we understand that the stigma around investing can be intimidating. So, why are so many people afraid of investing? Well, I think it all boils down to that dreaded fear of losing everything that you have. That's definitely the elephant in the room. This fear stems from the idea that you have to be a financial guru with an encyclopedic knowledge of jargon like PE ratio, gearing, and whatnot. And the sad part is, many folks let this fear hold them back, missing out on potential wealth accumulation. But the truth is, investing is not rocket science. It's not as complicated as it seems. You don't need a PhD in finance to start investing. To fully grasp the essence of successful investing, there's really only one thing that you need to do. And that thing is to critically think about how an investment asset generates income and how that income ultimately returns to you as an investor. It's that simple. Now, let's illustrate this concept using something that's incredibly relatable. Imagine a friend comes to you for money, telling you they want to start a new cafe business. Your friend, who has spent years perfecting their craft in the culinary world, approaches you with the detailed business plan, market research, and a clear vision for their dream cafe. They work in a renowned restaurants, manage kitchen operations, and have a loyal following of food enthusiasts who can't wait to taste their creations. In this case, your investment feels like a smart move. You know they have the skills to create a menu that stands out, manage the kitchen efficiently, and provide a top-notch dining experience. It's not just about trust, it's about confidence in their ability to turn your investment into a successful venture. On the other hand, if your friend lacks any relevant experience in the food and beverage industry and approaches you with only a vague idea and a passion for food, you might find yourself in a riskier situation. It will trigger you to think further, because without the necessary knowledge, they could make costly mistakes, mismanage funds, and underestimate the complexity of running a restaurant. So, before deciding to invest, you're going to start thinking and have some very critical conversations with your friend. You're probably going to ask about their business plan, because that outlines everything from the concept and menu to the budget and marketing strategy. A well thought out plan shows that your friend is serious and committed about the business. After that, most likely you still have doubts in your mind. So you're going to ask your friend how they came up with the idea. Did they do enough market research to conclude that it is a viable business to venture into? Who is their target audience? Competition? And what are the potential challenges they may face in the business journey? It's very important for you and your friend to know that those questions will agitate the mind to think what is the ingredient for the cafe to become a successful business. Then, the most important question: how is your friend going to use your money? Would the money you are investing in itself enough for the cafe to operate? Or does your friend need to top up more fundings by taking up a business loan? Can your friend afford the interest expenses of the loan? At this point, you might be thinking, I'm no financial expert. How can I ask the right questions? But when your money is on the line, trust me, these questions come naturally because you're driven by the need to protect your investment. Often, after reviewing the business plan, market research, and financial projections, people decide whether to invest or not. But let's be honest, chances are your friend has painted a rosy picture about how well the cafe would be to attract you to invest a stake in the business. Ultimately, it is our responsibility to be aware about the risks that we are getting ourselves into. So for me, I always think about all the possibilities to go wrong in a cafe business and assess if my friend is prepared for unexpected hurdles, like a sudden drop in customers or a supply chain disruptions. If the friend already has a contingency plan to tackle my concerns, it's definitely a more solid investment to venture in. Now, I'm not saying that investing in a cafe with an inexperienced friend is a bad idea, but it does come with higher risk. If you decide to proceed, make sure you know what you're putting yourself into. But now you can see, it's a very sequential process to derive an investment decision, even though you know nothing about cafes. And that's the beauty of it. You don't need to be a finance expert to make informed investment decisions. All it takes is a logical, step-by-step approach. Remember, this approach can be applied to any forms of investment, not just a cafe business. It's about understanding the fundamentals of the venture, assessing risk, and making an informed decision. While investing always carries some level of risk, engaging with your critical thinking mind and following these steps can help you mitigate it and increase your chances of success. Along the way, you will naturally ask the right financial ratios that ties back to what you want to measure when searching for a stock idea. So let's practice the skill of critical thinking on the real-life stock market. And to prove that stock investing isn't really rocket science, I'm going to use one of the hardest sectors to explain how you can understand it like a piece of cake. And that sector is banking. First of all, we need to know how a bank works. The simplest way of explaining how a bank makes money is that they lend money to people and earn an interest from it. Now, money that banks use to lend to people doesn't just fall off the sky. They need a strategy to raise funds. Most of the time, this is done by offering fixed deposits or FDs to people like us, attracting us to put money in the bank with perceived high interest rates. Now, the difference between the bank lends to people and what it pays us for the FD is the spread, or the interest margin that the bank makes. That's how banks make money. Without knowingly, I know you start to have questions coming. What if the bank does not have enough money to lend to people? This is where we start to question their business plan. Maybe the bank wants to offer at even higher FD rates to attract more people to save with them, but this means the cost of the bank will increase and affect their interest margin. Or maybe the bank wants to target a certain group of customers, like big multinational companies, to open a corporate account with them because big MNCs employ a lot of people, and when they pay their staff salaries to the bank can use that money to lend out for profit. What comes next is who the bank is lending to in order to maximize profit. Personal loan is the best business because interest rate for that can be as high as 15%, while a mortgage loan is only 4%. While that is true, we don't want a bank that lends out all the money as personal loans because if somebody decides not to repay their loans, there's very little chance for the bank to recoup the money. A mortgage is a lot safer because if the borrower doesn't pay, the bank can lelong the property ma. Recently, we heard a lot of bad news in the banking sector, especially in the US. I've made a video about that on Mr. Money TV channel. You can check it out here if you are interested. But the point is, if the world's largest economy can have banks that are operating so poorly, how strong are the banks that we plan to invest in? I think you roughly have some clues by now. The strength of a bank depends on the bank's loan portfolio and any other investments that the bank undertakes. How much money they lend out as personal loans, mortgage loans, business loans, so on and so forth. All this will reflect if the bank has a high risk of over-lending and not being able to collect them back from borrowers. Fortunately, Malaysian banks are quite prudent and they always keep enough buffer to weather any downside risk. So there you have it. Without a PhD in finance, without having technical knowledge and skills to crunch financial data, you know what kind of banks you want to invest in that suits your investment style. When you do this exercise long enough, eventually you will start to pick up more jargon to help you in your investment decisions. If you sign up for Mr. Money TV's newsletter, I write every Friday to provide updates about economies, stock markets, and investments to help you guys understand complicated financial information in a more casual and bite-sized manner. On top of that, there's also freebies to download when you sign up. So what are you waiting for?